Hey everybody, and welcome back to another video. This is How to Invest. Spencer here, and this one's going to be a new video on a new stock. This is going to be Dropbox, ticker symbol DBX. So if you are unaware, this company operates in a software as a service company, SaaS for short, which are very, very highly coveted typically in the stock market due to their high margins. So, as we like to start off on this channel, the market capitalization for this stock is $9 billion currently, and their stock price per share is just under $24 at $23.91 in the after hours. If we take a quick look at the chart, the stock is down quite big time on the past month, and even if we go to the past 6 months, the stock peaked out around 32. I think it was closer to $35 on the intraday, intra-week. This just kind of averages out the chart and has fallen all the way down very, very quickly, forming an almost backwards J. And it looks like we're trying to start to break out again. But I wanted to make this video just kind of as an update because I have currently made money in this stock before and have closed out my position. I bought in just around, I believe, this region of last year and sold out actually pretty recently, back in, I believe it was July, or June or July in this period, right after it broke in the 30s. I had made over a 50% gain in a very solid amount of time, and it was very, very stable, and you can see here it was very, very sustainable, almost a clear uptrend during that period of time, and I just thought, hey, I had made a decent amount of money, and I took all of my profits, just because for me, that was all I was planning on making in the stock, was 50%, and it just happened much quicker than I was anticipating. If we look at some of the stats to try and value the stock and see if it's currently undervalued, overvalued, or at current value, we can see here that their trailing price to earnings is very, very high at 116. But if we look towards the future and what they will be earning, it's very cheap and undervalued. So typically for the stock market, the S&P 500 has an average forward price to earnings of around 20 to 25, which is not too much above this, but these price to earnings, as you increase, a very small increase is felt big time within the stock price and especially the market capitalization. If we look at some of their highlights from their financials, we can see from the past 3 quarters of the year, they do have very, very high operating margins. You can see that their profit margin has been negative, but I am going to exclude that just for this analysis. And their operating margin is very high. Anytime you're able to get above double digits, it's a very lucrative company, and they're making a decent amount back from what they charge. If we go down to their income statement, they've made $2 billion for 3 quarters. And this company is only worth just about $9 billion, which is very, very, very good in my opinion and bullish. But even more bullish stat on this list is their gross profit was $1.5 billion. So they're almost all of their money is hitting the bottom line from these past 3 quarters. We can see that that's a 131% increase year over year, which is the money hitting the bottom line, which is just phenomenal. If we go down to their balance sheet, this is where we start to see a little bit of cracks in the foundation, just because they do have a decent amount of debt compared to their cash. They aren't able to pay all of it off currently, and this is why it has fallen so rapidly in such a short period of time, because there have been lots of fears over interest rate increases much sooner than expected, and typically the stock market is a forward-looking instrument, and people like to price in things into the future. And people had priced in very, very low interest rates, close to zero, which is what we're currently at, for much longer. They had to price this in up until the year 2023, but it's recently been hypothesized that these could actually start to increase in the summer of 2022, if not sooner, if we start to see inflation running rampant and the Fed act more quickly. So as a result, companies that have higher valuations, which this would be especially in the short term, considering that their trailing price to earnings was 5 times average of the S&P 500, and also because they do have a good amount of debt on their balance sheet that they were looking to take advantage of while interest rates were low. And as interest rates begin to increase, people have to revise their models on how much interest this company will have to pay back on their debt. And $2.5 billion is definitely nothing to scoff at, considering their market capitalization is only $8 billion, and they've only taken in $2 billion for the first 3 quarters of the year. So that was just one issue that I had with the balance sheet currently. If we go over to the share stats, there is another slight issue, not too big of a problem for me personally, but this stock is very, very coveted by hedge funds. We can see here that over 80% of the stock is held by institutions, and very little is still held by the insiders, but there have been buybacks recently. If you follow CNBC's buyback program by Brian Sullivan, very, very helpful and insightful. But the other thing that I want to notice is that their short percentage is also quite high. I note on the channel, anytime it's over 5 is definitely notable, and this is definitely over 5 and closer to eclipsing 7.5, which would be on its way to becoming not an issue, but something that you definitely have to take into account for the stock looking forward, just because it can cause more volatility to the upside or the downside in the stock, which is exactly what we've seen in the stock and why I believe there is so many shorts in it. If we look at the technicals and the candles, we can see that this stock has been nothing but stable since it IPO'd back in 2018, March. So it IPO'd around $28 and went almost straight down. It did have a nice pop initially, went up above 40, but went all the way down to the teens, around 15, in the COVID crash of March 2020, and has been range bound, honestly, for a long period of time. Really, the whole chart, you could say, is a very, very short range for the stock. But I drew these 2 channels as a current bounce off of some levels that we've had recently. If we zoom in, we have bounced right off of this line, and it looks like a double bounce with the wicks on 2 or maybe 3 of these candles if you move it a bit higher. But I wouldn't consider this too strong of a resistance or a support, I guess, not a resistance because it's on the downside, because it does look like we're in a very, very clear downtrend for the stock. Like I said earlier, software as a service companies have been absolutely hammered due to the interest rate fear mongering and people believing that just interest rate increases can happen sooner than believed, and when they do, there could be more that need to happen as a result of inflation running rampant. So a lot of people are freaking out and selling a lot of their highest valued stocks or stocks that they've had the most gains in. But the second line that I drew was at $20. We have seen quite a bit of consolidation there too, and a good amount of bounces and supports, resistances, just along the way, right around that arbitrary number. I've said in a couple videos in the past, technicals and really stocks and trading anything currency is mostly human psychology, and typically humans are what I like to say stupid enough to make arbitrary numbers that are a multiple of 5 important. In this case, 20 is definitely an important number on this graph. But like I said earlier, this isn't an obvious downward trend, and we have seen some bounces off of this right around 24 level. But I believe that if this stock falls into this box and range, then it is a very, very good deal on the market, just because nothing has changed with the fundamentals of this company. Fundamentally, this company is very, very good. They have very, very sticky products that they provide to people. And really the only risk to this company is lack of user growth and churn rate, because I believe that they'll be able to become profitable and increase their profit margins as people tend to realize how sticky their products are and just how useful they are, just because they do have just so many users using their products for storage, and also HelloSign, which is a very, very fast growing field, along with DocuSign. But like I said, if this stock does fall into this box, I believe that it will be a phenomenal deal. This obviously could fall through back into the teens if we do see a good amount of market weakness and we can continue to see downtrends in the indices. But I believe that's a little unlikely, just due to the fact that we have seen so much consolidation in these regions. And I don't think that we will have too much pain in the indices to come. But if it does, we'll be an even better buying opportunity, because this company is very, very profitable and will look to become even more profitable in the future. If you guys made it this far into the video, thank you very much for watching and have a great rest of your day.